Welcome back, and thanks for being with us this morning on the Open here on BNN Bloomberg. We're now 24 minutes away from the open of regular market trading. There's the setup. It is negative, and we highlighted the reasons why. Most obviously, the market's still getting adjusted to the Fed's new outlook, and the political dysfunction in Washington is a factor as well. Let's bring in an expert to talk about it in more depth. Lesley Marks is Chief Investment Officer at Mackenzie Investments, and she joins us now. Lesley, thanks a lot for coming in.
Good morning.
Well, all of a sudden, we don't just have political dysfunction in Washington. We've got it here in Canada as well, with an abrupt change in the finance minister portfolio, a cabinet shuffle coming today, we understand, and an increasing number of MPs, 18 was the last count I saw, who are now publicly saying that the prime minister should resign. How should Canadian investors be thinking about this?
Well, I think at the top of Canadian investors' wish list for the holidays would probably be some more clarity around the future. And I think what will come, what we will likely see in the new year is get that clarity. So I think investors need to really latch on to the fact that we see this very much as a temporary state. We don't think that we'll be waiting until October to see an election call one way or another. There will be a call for an election in the first quarter of next year, and I think that investors should applaud that. I mean, I think this is the issue here. Nobody likes instability. Nobody likes uncertainty when it comes to investing. As we've talked about all week, this is not a time for chaos within our government. We need to be a strong, united force here.
With the tariff situation on the near-term agenda as of January the 20th, correct?
Exactly.
Is that
I mean, that should really be the focus of the government, which is the strategy to approach the threat of tariffs with our largest trading partner.
One way to easily measure the view of the world and markets to the situation in Canada is the Canadian dollar. It serves as an index, really, on sentiment on this country, and it's at a four-year low. And only 4 times over the past nearly 30 years has the Loonie been sub 70 cents. And there's been a reason each time for that. The crash in energy prices in 2016 was a reason. The pandemic was another reason. And then if you go way back to the mid-90s, the infamous fiscal situation in the federal on the federal books was a catalyst. At that time, the Wall Street Journal wrote a famous editorial referring to the country as a banana republic way back then. What's your view on the Canadian dollar? Is it at a low here?
Well, I think that Canadian dollar is the correct area to focus on here because it is a marquee of a lot of what is happening here. So first of all, talking about the political situation, certainly that's weighing on the Canadian dollar from a foreign investor perspective. Foreign investors are looking at Canada and again, talking about that uncertainty. And this is why I said at the top of one's wish list should be more certainty around our political future and the calling of an election. So I think that would actually create some support for the Canadian dollar and potentially put in a low for the Canadian dollar. But there are other factors here, and they've been really highlighted this week when you think about what the Federal Reserve is saying when it comes to their outlook for cutting interest rates versus what we heard from the Bank of Canada a week ago. The Canadian economy is underperforming significantly versus the U.S. economy, and that also weighs on the Canadian dollar. So it is not just about our political turmoil. There are other factors, economically related, foreign fund flows, so lots of other factors. And generally, the U.S. dollar strength also has been an issue for the Canadian dollar. Because if you look at the Canadian dollar performance versus other currencies, it's not underperforming to the same extent that it is to the U.S. dollar, which tells you this is not just about our current political situation.
As is very often the case, it's really a story of the U.S. Dollar in terms of where our currency is going. Okay, let's go to stock markets. What kind of year are you expecting in 2025?
Well, we always go back to the fundamentals. I mean, obviously, there's a lot of political noise and rhetoric happening in markets right now, but the fundamentals are still fairly good when it comes to earnings. The best place for earnings growth right now is in the U.S. What we've heard from the Federal Reserve this week is we're not likely to get the tailwinds from lower interest rates from a monetary policy perspective. So it's really going to come down to earnings. So if earnings continue to come through at the strength that they are, we just saw a great, strong Q3 GDP number out of the U.S. So that is a very good signal for the future when it comes to earnings. We think that stocks can actually continue to rise.
The consensus call on earnings growth appears to be about 15 or 16% among S&P 500 countries. Companies. Is that what you're expecting?
I think that you could see, I mean, it's always the highest at the start of the year. So you could see that number come down. But even if you saw that revised downwards, 2 to 3, 4%, which is very normal throughout a year, you could still see upward movement in stock prices. Just keeping the same multiple, stock prices could continue to rise in the U.S.
Will the Fed continue to be, or perceptions of the Fed continue to be a negative headwind, or will the market adjust to this forecast, which really, in terms of the fixed income market, was not a surprise of any kind?
So I think the market has already adjusted to the current Fed expectations, moving down to expectations of 2 interest rate cuts next year. The real question, Paul, is going to be, is that the right forecast? Could it be less or could it be more? Or even on a tail risk expectation, could the Fed actually have to increase interest rates? And that really will come down to the outlook for inflation and concerns around, a lot of the policies that are being talked about, such as tariffs, trade war in general, could be inflationary, and that could take those 2 interest rate cuts off the table. So that's where we could see a change in the forecast.